72 hours ago, silver crashed 31% in a single day, $15 trillion erased, while you watched the price plummet from $122 to $84. Something far more dangerous was happening in the shadows. In Singapore, buyers are paying $100 for silver. In China, $163. But on American exchanges, $84, the same metal, 3 different prices. One of these markets is lying. And in 25 days, on February 27th, the truth will be forced into the open. What happens next? We'll rewrite the rules of global finance. But here's what they're not telling you. Welcome to IU and Ag, where we decode the real movements of wealth that shape economies. If you've built something in your life, a business, investments, a legacy for your family, then what we're about to discuss in the next few minutes matters more than any headline you'll read this week. Now, I'd like to ask you something, and I'm asking this with respect, the way I'd speak to someone whose experience and judgment I value. If you find strategic value in understanding what's really happening in markets, not the noise, but the actual structural shifts that affect real capital, would you consider subscribing to this channel? We don't chase trends. We analyze the economic forces that move billions in capital before most people even notice. And one more thing, I'm curious. Where are you watching this from today? Are you in North America, Europe, Asia, the Middle East? Drop your location in the comments. We're building a global network of serious thinkers who understand that markets don't always tell the truth, but reality always does. Now, let's examine what happened 72 hours ago and why the next 25 days will determine whether we're witnessing a market correction or the beginning of a systemic breakdown. February 2nd, 2026. Exactly 72 hours after the crash. Traders around the world are staring at their screens, confused, because what they're seeing shouldn't be possible in modern markets. On Friday, January 30th, silver experienced the most violent single-day collapse since 1980. The price dropped from $122 per ounce to $84 in a matter of hours. A 31% crash. $15 trillion in market value vanished. Panic selling, forced liquidations, margin calls, chaos. But here's where the story becomes strange. While paper silver, the contracts traded on exchanges, crashed to $84, something else was happening in the physical world. The world where actual metal changes hands. In Singapore, one of Asia's largest bullion dealers, Bullion Star, posted an update on their website. They weren't celebrating lower prices. They were raising their premiums. For a 1,000-ounce silver bar, the kind banks and institutions buy, they were charging spot price plus 5.99%. For smaller 100-ounce bars, spot plus 10% to 12%. For 1 kilogram bars, spot plus 12% to 15%. For silver coins that investors could hold in their hands, spot plus 15% to 20%. Think about what that means. The exchange in Chicago says silver is worth $84, but in Singapore, buyers are paying $95 to $100 for the exact same metal. And Singapore isn't alone. In China, the situation is far more extreme. On JD.com, China's largest e-commerce platform, bigger than Amazon in Asia, retail silver is listed at $163 per ounce. Not $84, $163. That's a 94% premium over the official COMEX futures price. In Dubai, premiums hit 40%. In Japan, secondary market platforms are showing 60% premiums. In India, where silver crashed to Rs 2,925 per 10 grams on paper, physical dealers can't keep inventory on their shelves. This isn't happening in one country. This is happening everywhere. And it's not getting better. It's accelerating. Now, in a normal market, this should be impossible. When futures prices crash 31%, physical premiums should disappear. Arbitrageurs, the traders who profit from price differences, should flood into the market. They should buy cheap COMEX contracts, demand physical delivery, then sell that metal in China at a 94% premium. Free money, simple arbitrage. But it's not happening. Why? Because COMEX, the Chicago Mercantile Exchange, where silver futures trade, doesn't have the metal to deliver. The numbers tell a shocking story. As of February 1st, COMEX has 127 million ounces of silver in registered inventory. That's the silver available for delivery to contract holders. But here's the problem. Open interest for March 2026 contracts that expire in just 25 days, stands at 118,000 contracts. Each contract represents 5,000 ounces of silver. Do the math. 118,000 contracts multiplied by 5,000 ounces equals 590 million ounces of silver promised for March delivery. COMEX has 127 million ounces. They've promised 590 million ounces. They can't even cover 20% of the contracts if delivery is demanded. Historically, this hasn't been a problem. Only 1% to 2% of futures contracts ever demand physical delivery. Most traders just want price exposure. They settle in cash. They roll to the next month. They don't actually want the metal. The system works because nobody actually wants delivery. But something changed in January 2026. Between January 8th and January 15th, just 1 week, 33.45 million ounces of silver were physically withdrawn from COMEX warehouses. That's 26% of registered inventory gone in 1 week. And when silver broke past $120 during the rally, COMEX actually halted trading for several hours. The official reason they gave, data center outage. The real reason, they couldn't handle the delivery demands. Analysts are now calling this moment the Great Divorce. For 50 years, paper silver and physical silver moved together. Price discovery happened in futures markets in Chicago and New York. Physical premiums stayed within 1% to 5%. The system worked. But on January 30th, 2026, that system broke. Now there are two markets, the paper market, controlled by margin requirements, forced liquidation, algorithmic trading, leverage ratios, and exchange rules. Current price, $84 per ounce. The physical market, controlled by actual supply and demand, industrial needs, investment demand, and delivery capability. Current price, $90 to $163 per ounce, depending on where you need the metal delivered. One of these markets is telling the truth. One is lying. And over the next 25 days, the world will find out which one survives. While traders were busy watching price charts crash, something far more significant was unfolding beneath the surface, a crisis that's been building for 5 years. A crisis that Friday's crash didn't create, it merely exposed. Let's talk about numbers that Wall Street doesn't want anyone to examine too closely. In 2021, the global silver market ran a deficit of 100 million ounces. That means the world consumed 100 million more ounces than miners could pull from the ground. In 2022, the deficit grew to 140 million ounces. In 2023, 170 million ounces. In 2024, 200 million ounces. In 2025, 230 million ounces. Add those numbers together, 840 million ounces. That's more than an entire year of global mine production. Simply gone, consumed, vanished into industrial applications, absorbed into electronics that will never be recycled. Now here's the question nobody's asking on financial television. Where did that 840 million ounces come from? Because if miners couldn't produce enough, someone had to supply the deficit. The answer is simple. Above ground inventories, ETF holdings, bank vaults, exchange warehouses, private hoards. For 5 years straight, the world has been eating through its stored silver to keep industries running. But those inventories are now nearly gone. COMEX registered silver, the metal available for delivery, is down 70% since 2020. The London Bullion Market Association, down 40% since 2020. The Shanghai Futures Exchange, sitting at its lowest inventory level since 2015. The cupboards are bare, and demand isn't slowing down, it's accelerating. In 2026, solar panel installations alone are projected to consume 180 million ounces of silver. Electric vehicles, 50 million ounces. Electronics, phones, computers, appliances, 240 million ounces. 5G infrastructure, 30 million ounces. And then there's the new variable nobody calculated for 2 years ago, AI data centers. Every AI server farm, every GPU cluster training, the next generation of artificial intelligence, requires silver. And that demand is growing exponentially. Total industrial demand for 2026 projected at 700 million ounces. Mine supply for 2026, 835 million ounces. That leaves 135 million ounces for investment demand. But investment demand in 2025 was over 300 million ounces. The math doesn't work. Total demand exceeds 1 billion ounces per year. Supply can't keep up. The deficit continues. And then, on January 1st, 2026, China made a move that changed everything. New silver export restrictions, effective immediately. Under the new policy, only state-approved companies with annual production capacity above 80 tons can export silver. And even they need special government licenses. This effectively shut down hundreds of smaller exporters who previously supplied global markets. China produces 20% of the world's mined silver. And as of January 1st, they're keeping it. Why? Because China sees what Western financial markets refuse to acknowledge. Silver is no longer just a commodity. It's no longer just an investment metal. It's a strategic resource. China is building more solar panels than the rest of the world combined. China is manufacturing more electric vehicles than Europe and America together. China is rolling out 5G infrastructure across a nation of 1.4 billion people. And China is consuming more silver domestically than they can mine, so they made a calculation. It's more valuable to hoard physical silver then to sell it for dollars that may be worth less tomorrow. But here's where the story takes another turn. While China was hoarding, corporations started panicking. Samsung, Tesla, Panasonic, Bosch, major technology and automotive companies. They started doing something they've never done before. They began negotiating direct supply contracts with mining companies, bypassing the exchanges entirely. Think about what that means. These companies need silver for production, for manufacturing, for products they've already sold to customers who are waiting for delivery. And they've decided they can no longer trust the futures markets to provide reliable supply. So they're going straight to the source. They're locking in multi-year contracts with miners, guaranteeing purchases at fixed prices, securing physical delivery. This is called vertical integration. When industrial users start sourcing raw materials directly from producers, it means the traditional market structure has failed them. And there's one more player entering this game, a player that changes the entire calculation. Central banks, not just buying gold anymore, buying silver. Throughout 2025, emerging market central banks, nations in Asia, the Middle East, Latin America, quietly accumulated silver, not for industrial use, for reserves. Why? De-dollarization. As confidence in the US dollar as the global reserve currency weakens, central banks are diversifying into hard assets. Gold has always been the primary monetary metal, but gold rallied to $500-600 before Friday's crash. Silver, on the other hand, just became 31% cheaper, while the fundamental supply deficit got worse. If you're a central bank holding billions in dollar-denominated assets, and you believe the dollar will weaken over the next decade, what do you buy? Gold? Yes. But silver offers something unique. It's both a monetary metal and a strategic industrial commodity. It's cheap relative to gold, and it's becoming scarce. So while retail investors panicked and sold on Friday, while over-leveraged traders got margin calls and liquidated, central banks, corporations, and sovereign wealth funds were quietly positioning, not in paper contracts, in physical metal. Because they understand something the futures market hasn't priced in yet. You can print more contracts. You can't print more silver. There's a date circled on calendars and boardrooms across Wall Street, February 27th, 2026. 25 days from now. Most people have no idea why that date matters. But the people who move billions in capital, they're watching it very carefully. February 27th is first notice day for COMEX March 2026 silver contracts. On that day, every trader holding a March contract must make a decision. Option 1, roll their position to May contracts, push the problem down the road. Option 2, close their position, take cash settlement, walk away. Option 3, demand physical delivery. Right now, there are 118,000 open contracts for March delivery. In a normal year, maybe $100 of those contracts, about 1%, would demand physical metal. The rest would roll or settle in cash. The system is designed around this assumption. It always has been. But 2026 is not a normal year. Remember what happened in January? Between January 8th and January 15th, while silver was rallying past $120, $33.45 million ounces were withdrawn from COMEX. That's not 1% demanding delivery. That's 26% of total registered inventory walking out the door in 7 days. And when the system couldn't handle it, COMEX shut down trading. They called it a technical glitch. So here's the question that's keeping risk managers awake at night. What happens on February 27th if 10% of March contracts demand delivery? 10%. That's 59 million ounces. COMEX currently has 127 million ounces in registered inventory. They could handle it, barely. But what if 20% demand delivery? That's 118 million ounces. The warehouses would be nearly empty. What if 30% demand delivery? 177 million ounces needed. COMEX doesn't have it. And here's what makes the situation truly dangerous. The people holding these contracts now aren't speculators anymore. After Friday's 31% crash, the weak hands are gone. The over-leveraged traders got wiped out. The momentum chasers exited. Who's left holding March contracts? The people who actually want the metal. Industrial users who need silver for production. Sovereign wealth funds building strategic reserves. Family offices that understand what a 94% premium in China means. These aren't traders looking for a quick profit. These are entities that need physical silver, and they've just watched the physical market prove it's willing to pay double the paper price. So the calculation changes. If you're holding a March contract, and you know you can demand delivery at $84, then immediately sell that physical metal in Shanghai for $140. Why wouldn't you? That's a $56 per ounce profit. On a 5,000 ounce contract, that's $280,000. Multiply that by 10,000 contracts. $2.8 billion in pure arbitrage profit. But here's the problem. If everyone sees that opportunity and everyone demands delivery simultaneously, COMEX can't fulfill it. They don't have the metal. And that's when the term force majeure enters the conversation. Force majeure is a legal clause that allows an exchange to declare it cannot fulfill its contracts due to extraordinary circumstances beyond its control. It's never been invoked for precious metals on COMEX. But there's precedent in other commodity markets. March 2022, nickel on the London Metal Exchange. Price spiked from $29,000 per ton to $100,000 in 2 days. A Chinese trading firm faced $10 billion in losses. The LME canceled trades. They rewound the clock, declared certain transactions void, forced cash settlement. The traders who were right, who predicted the spike, who held winning positions, had their profits erased by an exchange decision. Because the exchange prioritized system stability over contract integrity. Could that happen with silver? The legal framework exists. If COMEX determines that fulfilling physical delivery would threaten the stability of the exchange, they can invoke force majeure. They can switch all contracts to cash settlement at a price they determine. The contract holders have no choice but to accept it. But here's what happens after that moment. The entire premise of futures markets collapses. A futures contract is supposed to be a promise. If I buy December corn futures, I'm guaranteed delivery of corn in December at the agreed price. That's what makes the system work. But if the exchange can say, sorry, we don't actually have the corn, here's cash instead, then what's the contract worth? And this brings us to the players who saw this coming. The smart money. On Friday, January 30th, at the exact bottom of the crash, at $84 per ounce, JP Morgan covered their entire silver short position. Think about that timing. JP Morgan has been one of the largest short sellers in silver markets for years, and on the most violent crash day in 40 years, they bought back every short contract. At the bottom, perfect timing. How do you cover millions of ounces of silver shorts at the precise low of a 31% crash? Option 1, you're incredibly lucky. Option 2, you know something others don't. Option 3, you helped create the crash. On January 29th, one day before the crash, the CME raised margin requirements for silver futures by 164%. That means traders who were using leverage suddenly needed to post much more cash to hold their positions. If they couldn't post the cash, forced liquidation, sell at any price. And who's buying when everyone's forced to sell? The entities with cash ready, waiting for exactly that moment. This isn't conspiracy theory. This is how markets work when you understand the mechanics. Raise margin requirements. Trigger forced selling. Buy at the bottom. It's been done before. It'll be done again. But this time, there's a complication the smart money didn't anticipate. The physical market didn't collapse with the paper price. And now we're 25 days away from February 27th. 25 days until contract holders must decide cash or metal. 25 days until COMEX discovers whether the March delivery demands will be manageable or catastrophic. Because if those warehouses empty, if force majeure is declared, the world will learn a lesson it hasn't had to face in modern markets. Paper promises are only valuable if someone can deliver what was promised. And right now, the math suggests they can't. There's another variable in this equation, one that most silver analysts are ignoring, but it might be the most important piece of all, Bitcoin. Right now, Bitcoin is trading at $77,994, down 5.17% in the last 24 hours. Down nearly 19% over the past 2 weeks. And it's sitting just above a level that could trigger a cascade nobody's prepared for. $74,000. Why does that number matter? Because $74,000 is Michael Saylor's break-even point. And MicroStrategy, the company that bet everything on Bitcoin, has accumulated 528,000 Bitcoin at an average price of roughly $74,000 per coin. If Bitcoin breaks below that level, MicroStrategy's entire position goes underwater. $39 billion in unrealized losses, margin calls, forced selling, bankruptcy risk. But here's why Bitcoin matters for silver. Throughout 2024 and 2025, Bitcoin and silver rallied together. They moved in sync. Both benefited from the same narrative. Dollar weakness, inflation concerns, alternative stores of value, distrust of central banks. When Bitcoin went up, silver went up. When Bitcoin pulled back, silver pulled back. The correlation was undeniable. But now, something different is happening. Bitcoin's current weakness is driven by sentiment, by technical chart breakdowns, by over-leveraged traders getting liquidated. Silver's crash on Friday was driven by margin requirements, by forced selling in paper markets, two different causes. And that creates the possibility of something that's never happened before, decoupling. Think about the fundamental difference between these two assets. Bitcoin has no supply deficit. Its issuance is programmatic, predictable. 21 million coins will eventually exist, and not one more. You can't run out of Bitcoin exposure. You can always buy more at whatever price the market offers. But silver? Silver is different. There's only so much physical metal. You can create infinite paper contracts, you can trade derivatives, you can build ETFs, but you cannot conjure physical ounces out of thin air. So here's the critical question for the next 25 days. If Bitcoin breaks below $74,000, if it triggers a broader risk asset sell-off, will silver follow it down, or will physical silver holders refuse to sell at prices that don't reflect actual scarcity? Because here's what's different this time. Bitcoin investors can exit instantly, digitally, at any price. Liquidity is deep. But physical silver holders, they're seeing 94% premiums in China. They're seeing 40% premiums in Dubai. They're watching industrial users bypass exchanges to source metal directly from mines. Why would they sell their physical silver for $84 when the real world is paying $140? They wouldn't. And that's how markets decouple. So let's map out the 3 scenarios for the next 30 days, 3 possible paths. One of them will play out. The question is, which one? Scenario 1. Full systemic collapse. Bitcoin breaks below $74,000 this week. MicroStrategy faces margin calls, forced to sell Bitcoin holdings, cascading liquidations across crypto markets. Panic spreads to all risk assets. Stock markets drop. Bond yields spike. Dollar strengthens temporarily. Silver gets hit with another wave of forced selling in paper markets. Price crashes to $65, possibly $70. But here's where it gets interesting. Physical premiums don't collapse, they expand. China's premium over COMEX hits 120%. Retail dealers in Singapore, Dubai, Tokyo, completely sold out. Industrial users panic. They need silver for production. They can't get it at any reasonable price. February 27th arrives. March contract holders demand delivery. COMEX doesn't have the metal. Force majeure declared. Cash settlement imposed. And at that moment, the paper silver market loses all credibility. Two-tier market becomes permanent. Paper silver trades at $70. Physical silver, if you can find it, trades at $150, $180, maybe higher. The system breaks completely. Scenario 2, stabilization and recovery. Bitcoin holds $77,000 support, bounces to $82,000 by next week. Geopolitical tensions with Iran de-escalate. Risk appetite returns. Traders realize the CME margin hikes were the final shakeout, not the beginning of a collapse. Silver bottomed at $84. The weak hands are gone. Physical buying accelerates globally. Sovereign wealth funds, family offices, industrial users, all accumulating quietly. By February 15th, silver is back at $100. By March 1st, it breaks above the old high of $130. Paper market is forced to adjust to physical reality. Premiums narrow but remain elevated. March delivery proceeds without crisis. COMEX survives barely. But everyone now understands the paper market no longer controls price discovery. Silver enters a new regime, $150 by summer. $200 by year end, not because of speculation, because of structural scarcity that can no longer be hidden. Scenario 3, the Great Reset. This is the scenario nobody's publicly discussing, but it's the one that makes the most sense given the numbers. Bitcoin stabilizes, markets calm down. February 27th arrives. March contract holders make their decisions, and 15% of them demand physical delivery. That's 88.5 million ounces. COMEX registered inventory, 127 million ounces. They can technically deliver, but it drains 70% of their warehouses. April contracts come up. Same problem. May contracts, same problem. By mid-March, COMEX faces a choice. Continue delivering physical metal until warehouses are completely empty, or invoke force majeure now while they still have some inventory left. They choose force majeure. March contracts settled in cash, but not at $84. COMEX announces cash settlement at a premium to spot price, maybe $110. Maybe $120. They acknowledge they cannot deliver physical silver at the quoted futures price, and in that moment, everything changes. Price discovery shifts to Shanghai and Dubai exchanges. Physical silver begins trading in a range the Western world hasn't seen. $150, $175, $200 by summer 2026. Western paper markets become irrelevant. A new commodity pricing architecture emerges, not controlled by Chicago or New York, controlled by whoever actually has the metal. 3 scenarios. One will play out over the next 25 days. Which one? Nobody knows for certain. But the indicators to watch are clear. Bitcoin price action. If it holds $74,000, recovery is possible. If it breaks below, cascade begins. COMEX inventory levels. If withdrawals continue this week, crisis accelerates. Shanghai premium over COMEX. If it widens beyond 50%, physical market is taking control. Dealer availability. If major bullion dealers remain sold out through mid-February, structural shortage confirmed. Silver lease rates, currently at 8%. Historical average is 0.3% to 0.5%. If rates spike above 10%, desperation. The next 25 days will be historic, not because of what's happening in price charts, but because of what's happening in the real world, where actual metal must be delivered. And here's what every serious investor, every business owner, every treasury manager needs to understand. Paper markets can pretend there's plenty of silver. They can print more contracts, adjust margin requirements, manipulate price discovery. But physical markets don't lie. When Shanghai pays 163s and Chicago quotes 84 out of dollars, one market is connected to reality, the other is not. History has shown repeatedly that when paper markets diverge from physical reality, physical always wins. It just takes time. The question isn't whether the divergence will resolve. The question is how violently it resolves. March 2026 will provide the answer. And when it does, the precious metals market will never be the same again.